So with the RRSP season coming to a close, next we're going to move on to tax filing season. Now to celebrate going into a tax filing season, I thought for this week, let's do a video on taxes. But instead of talking about tax filing, like what you can write off tax, etc., which I will talk about later on in other videos, I want to kick this off by talking about a more special and interesting topic, and that's tax avoidance. What happens when someone uses tax advantage or tax schemes that made sense on paper but is actually banned or not allowed by CRA? What are they and what are the consequences they will create? Now, by here you might say, well, I don't do any of these tax schemes. I just file tax assets. I stick to the rule. I don't need to watch it. It doesn't apply to me. I would encourage you to watch it anyway, because even though you don't do it, you might know someone or in your family or your friends that might be doing these schemes or being sold to do one of these tax schemes, and they didn't know they're doing tax avoidance on purpose. So no matter what, I think this is very important to recognize these schemes so that you don't fall into these traps later on. Alright, so with that out of the way, without further ado, let's jump into today's video. So when it comes to tax strategies or actions, there are generally three different categories. The first one is tax planning. This is where you are sticking to a rule, you're doing things according to the Income Tax Act, you're not abusing anything. So for example, buying RRSP, writing off the mortgage interest on your investment properties, those are perfectly fine and you can do them. That's tax planning. The next category is tax evasion. This is where you're trying to hide your income or pay less tax. So for example, let's say you drive for Uber and you don't report your Uber income, that's tax evasion because you're supposed to report it. Or you're self-employed and you're writing off your grocery bill that has nothing to do with your business. That's also tax evasion because by writing that off, you're trying to pay less tax. This is also quite easy to tell and why is whether you can do it or you can't. It's pretty easy to distinguish. The last type, however, is much harder, and that's tax avoidance. This is the trickiest one out of them all, and this is the one I want to focus on today. So first, what I'm going to do is talk about what tax avoidance is. Then I'll talk about when is it triggered and give some example of known tax avoidance schemes that have been banned by the CRA. And then finally, I'll be talking about consequences that you may face if you fall or you do one of these schemes, and what are some potential recourse or things you can do to protect yourself. Alright, so first, what is tax avoidance? Now, according to CRA, the definition is where when you're doing tax planning, but the things you're doing reduces tax in a way that is inconsistent with the overall spirit of the law. The CRA's interpretation of the term tax avoidance includes all unacceptable and abusive tax planning. Aggressive tax planning refers to arrangements that push the limits of acceptable tax planning. So essentially what they're saying is when you push the law, you misinterpret or you twist the meaning and you try to abuse the system. That's when you have tax avoidance. Now, long ago when I was taking different tax knowledge courses, an instructor said that tax avoidance basically is when you do each step, it makes sense on paper, it works, but when you do them all together, the CRA doesn't like it because they see it as an abuse of the law. Now, as you can imagine, these kind of description is pretty vague, which led to a lot of lawsuit between the CRA and the taxpayers. And back then, there were some rules like anti-avoidance doctrines or specific anti-avoidance rules to tackle different situations. But these description of these rules were very specific for each scenario, and as tax avoidance schemes evolve over time and constantly, CRA and the government found themselves have a very hard time to keep up with the changes and to combat these tax avoidances. By mid-1980s, they were seeing an unacceptable growth to these kind of avoidances, and CRA were having a very difficult time to recoup these money back. So in 1988, they introduced a rule called General Anti-Avoidance Rule, known as GAAR, which is a broad set of rules to counter potential tax avoidances. This allows the CRA to impose tax consequence to deny any tax benefit resulting from avoidance transactions. Ever since then, whenever there is a dispute about whether something is a tax avoidance scheme or not, they will look at the situation and determine if GAAR should be applied. So next, let's take a look at the General Anti-Avoidance Rule. Now, when it comes to whether we need to apply GAAR or not in each scenario, there is a three-step test that the court needs to look at. The first test is, does a tax benefit arise from transaction or series of transactions? Second test is the transaction an avoidance transaction? And number 3 is the avoidance transaction, a tax benefit abuse. Basically, they want to know if this person is doing all these transactions to deceive the CRA or to misinterpret rules on purpose to abuse the system. Now, one thing to note here is the burden of proof. When it comes to tax litigation, the burden of proof for first 2 steps of GAAR actually lies with the taxpayer. So what that means is CRA can make any factual assumption they want, and it's up to the taxpayer to provide proof and refute the claims for the first 2 steps. However, when it comes to the last step, whether these transactions are abusive or not, the burden of proof becomes CRA's problem. So if ever a taxpayer is challenged, the first 2 steps is on them and the last step is on the CRA. So next, let's talk about some commonly known tax schemes that people need to watch out for and has been warned or disallowed by the CRA. Now for this part, I'll be mainly talking about 2 examples that are well known and a lot of people do them or has been warned already by CRA for the last 10 to 20 years. Keep in mind there is a lot more tax avoidance scheme out there. Probably a new one is popping up every month. So what I'll do is I'll also provide a link in the description below that takes you to the CRA website for these kind of schemes. So if they update on the ones you need to watch out for, you can check them out over there as well. So the first example I want to talk about is a charitable gifting arrangement, which is also known as leverage charity program. This was extremely popular back in the 1990s to the year 2000. Now, the simplified main selling point goes something like this. You can donate money to a specific trust, which is set up by these scheme promoters, and then you can sign up to be part of these trusts. They then use your money to buy, for example, like expiring medicines and then donate them to third world country. Now, because they're near expiration or expiring, you can get them, wholesale for pretty cheap over here. But individually for each bottle of medicine, because they haven't expired fully yet, they still have quite a bit of market value on paper. So what the organization does is they donate them to third world country and then they issue you a donation receipt that is 3 to 5 times more than what you donated initially. So basically you can donate $1,000 on paper and then you get a $3,000 to $5,000 tax receipt back to you to write off your tax. Now, something you need to take a note is whenever these tax schemes promote them, it's always too good to be true. And in this case, it just seemed absolutely crazy to me and no way in hell it will work because you can't put in some donation and then get much more than what you put in back as donation tax credit. That just doesn't work at all. If it works, then nobody will be paying tax in Canada. Even though a lot of you probably already know that it sounds too good to be true, back then it was extremely popular, and at its peak there is probably over 100 different organizations all promoting these schemes or in different variety. And obviously eventually CRA will come in, look at this scheme and basically tell you there's no way it will work with this, allowing everything and everyone, and we're auditing everyone who has claimed these kind of write-offs. And as of early 2010, $4.5 billion in charitable gifting arrangements have been denied, and 130-something thousand taxpayers were reassessed or audited. And keep in mind that because CRA takes a long time to go through all the tax filing and then come back and audit you. So if you have participated in these programs from before you haven't get audited, maybe you got lucky, but I doubt it. I just think that it hasn't been time to come back and audit you yet. So be prepared for these kind of reassessment and auditing. And the penalty, as we'll talk about later on, can get quite hefty. Now next, let's jump into another example, and this one is a lot more recent, and that's the TFSA maximizer. Now, ever since I made this channel, every 1 or 2 weeks, I will get a request from my subscriber or viewers, sending me a link on an article on the TFSA maximizer and ask me if I can, teach them how to do it or set this up for them. And obviously I would decline every time because number one, it sounds like and looks like a tax avoidance scheme, and I tell them it looks like one and warn them about doing so. And second of all, to be honest, I watched this maybe 5-6 times. I still don't understand how it works actually. It's extremely confusing. And on the screen here, I've built kind of like a flow chart to try to simplify and explain as simple as possible. Now, I'm not going to go into detail because again, I don't fully understand it, but I think the general idea is that promoter has a mortgage investment corporation, a MIC, and then they are telling the taxpayer to join the MIC, and then they give 2 different shares. There's a high dividend paying share that is going to your TFSA, and there's a low dividend paying shares that are going to your RRSP. You change your investment to subscribe to these different shares into a MIC. And then you take a principal property, you lend against that and get a HELOC out, and the lender will be the MIC itself. The interest rate they charge would be the same as the dividend rate you're getting, so you don't pay anything on paper. And then you reinvest that money back into the MIC, and so you can write off your interest as well. And then lastly, you draw from your RRSP, which you can offset the income with the interest you just roll off, and then you can drain your RRSP account, and over time, your RRSP account should shrink to zero, while your TFSA, because of the super high dividend paying investment, should expand to an enormous amount. That's why it's called TFSA Maximizer. Now, just hearing me talk, it already sounds super complicated, super confusing, and this is why up until today, I still don't fully understand how it works. But you don't need to, because it has already been banned by the CRA. The CRA has already issued a warning about these schemes. Basically, this makes no sense because number one, you cannot charge yourself 15% on mortgage interest. This is not commercially reasonable. And number two, this whole procedure is you loaning against your own home, reinvesting into an investment that is risk-free. You are just charging yourself a high interest on purpose to get that return on paper. There's literally zero risk you'll be taking in these procedures or any economic gain for the society because you're not taking risk, you're not actually doing real investment. Now, despite the fact it's very confusing, probably nobody gets it, and it looks like a tax avoidance from day one, it has been very popular for the last 2 to 3 years. Even today, if I go online and search TFSA Maximizer, I'm still seeing a lot of YouTubers promoting it, and I even see literal financial services website have a dedicated web page just to talk about TFSA Maximizer and still trying to get people to sign on. Some of these websites actually are affiliated with pretty big name firms. If you're watching this video, you're working for a compliance department, I urge you to review all your advisors' website to make sure they're not talking about this TFSA Maximizer anymore because it doesn't work. CRA will audit everyone who try to do these kind of schemes. Now, when it comes to schemes, before we talk about consequences, I want to talk about some similarities that we always see when these tax avoidance schemes prop up. Number one is it tends to be pretty complicated. A lot of time it has trust involved or limited partnership, etc. The purpose is really try to confuse the CRA and deceive them and make it difficult for them to unravel what is really going on. So when you see something that's extremely complicated, that should be the first red flag. It doesn't necessarily mean it's a tax avoidance scheme automatically, but you should be careful. Now, number two is often it's designed to be risk-free. You get all the benefit with no downside, as we saw from the first two programs. They all promote the same thing, all upside, zero downside. And third, which is most importantly, to comfort you to make sure you sign on, they will always provide some sort of tax opinion from a tax lawyer to kind of confirm that this works and this makes sense legally. One thing to understand is that a tax lawyer's opinion or statement on the tax legality does not equal to CRA's standpoint. So just because some lawyer endorses it doesn't mean CRA is okay with it. And also, if you pay enough money, you can probably buy any endorsement you want on any product. So be extra careful if someone is trying to sell you the legality through a tax opinion paper. Alright, so let's say before watching this video, you have done this tax avoidance scheme already and you haven't been audited. Next, let's talk about potential consequences that you may face. The penalties for tax avoidance, which later becomes tax evasion as they get disallowed by the CRA, is quite hefty. Not only you have to pay back all the missed tax plus interest, which you can see on the screen here, depending on how many years you have missed, they get pretty heavy when it comes to interest rate. You also may get penalized for up to 200% of the tax benefit you receive from these tax avoidance schemes. Now, you may say that, well, it's not fair. I acted because some organization promoted it. They acted like they were professional and they gave me a tax opinion piece. It's all legal. Why just penalize me and not them? Well, don't worry. Promoters will get penalized as well. CRA can apply something called third-party penalty on these people who intentionally file or prepare false statements or assisted in doing so. The penalty for them is extremely hefty. It's a greater of $1,000 or the compensation earned off of each transaction per person, which you probably should because through your promotion or scheme, you have caused a lot of pain and suffering for the taxpayers as well as wasting a lot of resources from the CRA. Now, there are final details on different roles during this process, like if you're a promoter or you're a preparer or you're providing a statement, you all will face different penalties. So I provided a link in the description below if you really want to check out. Hopefully nobody watching this video here needs to actually use this website to figure out their penalty. So finally, let's talk about recourses and what are some things you can do to protect yourself. Though you still have to pay back all the penalty and everything, at the end of the day, you're still a victim of someone else's advice or promotion. So usually there will be class action lawsuit that will be going on against these companies. For example, one of the company GLGI, which promoted the charity gifting program heavily back then, now is facing a class action lawsuit from its 40,000 members who participated in this gifting scheme. So if you have been victim of these things, you can go on Google, find the company you sign on, and then add class action lawsuit at the end to see if there's any of these going on. You can sign up for free. Usually it doesn't cost you a dime to be part of the lawsuit. However, unfortunately, keep in mind that 99% of the time, you'll be lucky to get anything back. And even if you do, it's going to be pennies to whatever penalty you have to pay back to the CRA. Finally, to protect yourself, be very careful if someone pitches you something that's overly complicated or it promises too much benefit with seemingly no downside. Now, that is not to say that all complicated, strategies do not work. They're all avoidance schemes. There has been times where CRA tried to label something as tax avoidance, but the court later ruled to be not one. So for example, in the case of the Evans versus the Queen in 2005, this taxpayer used sophisticated tax planning strategy to put corporate money into his own hands through minimal taxes. It was through a series of corporation and limited partnerships set up to do the exact same thing as if someone directly paying himself dividend, but this just has a lower tax cost. Since each step is well observed and respected within the Income Tax Act, he was ruled to not have the GAAR applied. Now, keep in mind that in this case, the taxpayer still pays some taxes. Every step was following the Income Tax Act, and he didn't try to twist any meanings. So it was hard to prove that he was trying to abuse the system. So the best advice is really every time you hear something that's very complicated and you're really not sure if it works or not, especially if it's a brand new strategy, consult a CPA for a second opinion or a tax lawyer. You can even call into CRA directly and whether it's a tax avoidance scheme or it's actual tax planning. Alright, so hopefully you have a much better idea of what tax avoidance is. I just want to shed some light on this because these things evolve all the time. It's very difficult to catch on initially. Hopefully this can give you a little bit more awareness. If you like everything I'm talking about today, make sure you hit the like button for me once. If you don't like them, make sure you hit the dislike button twice. Next, what I want to hear from you is, have you ever been a victim of these kind of schemes or been pitched one? What did you do with it? Did you go ahead? Or how did you figure out that this would not fly with CRA? Let me know in the comment down below. If you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button to get all the notifications in the future. Alright, this is Jackie Cole. I hope you found this interesting. I'll see you next week. Bye!